again, all we're doing is we're making equity in the home liquid. So here's how that looks. We talked about them using, so FHA publishes this table that tells what the lines of credit will be as a percentage of the value of the home. And oddly, actually, this makes sense when you understand the financial product and how it has to work. Those are based on age, because what FHA has to underwrite for is that you could use all of that credit and never make a payment again. And if you're 62, they have to have a pretty big cushion of equity for them to feel comfortable doing this. But if you're 92, they can lend quite a bit more because actuarially speaking, they know they're going to get that money back. It's going to get paid back sooner than if you're 62. Again, actuarially speaking, statistically. So the line of credit, where it starts as a percentage of the value of the home, is higher if you're older and lower if you're younger for that reason. But once it's in place, it starts growing based on the criteria I mentioned earlier, the 1 year treasury plus that spread. So let's say in this example, based on her age, her line of credit begins there. And then the balance, again, it's just like a HELOC or a credit card in this regard. There are some clear differences, but in this regard, it's just a line of credit and the balance is up to her. She can put more money on the balance if she needs to make some repairs on the home, or if she wants to take a trip and maybe she comes across a windfall and she pays the balance down. You can do whatever you want with the balance by putting money against it or taking money out. And then the charges that accrue, or the charges that happen, you can either let them accrue or you can pay them. It's completely up to you. The next animation that I'm going to show here is something like a time lapse. So I'm going to make two assumptions in this time lapse. The first assumption that I'm going to make is that the home value increases. So let's say this time lapse is 10 years. Now, home values don't always appreciate over 10 years, but I'm going to assume that it does in this example. I will use an example where it goes down. So I'm not trying to get out of anything. We're going to use this example first. So we're going to assume that the home value increases, and we're also going to assume that she doesn't want to make a payment. Now, we know what's going to happen based on the conversation thus far. If she doesn't make a payment, the balance will accrue. It will increase because she's letting the charges accrue on the balance rather than spending the money. Now, what she's doing with the money instead of paying the charges could be anything. She could be investing the money. She could be just living a higher lifestyle, or she may not have the money, but she wants to stay in her home and let the balance accrue. That's valid as well. So again, the two assumptions, you're going to see the home value increase, you're going to see the balance increase. The other thing that's going to happen isn't an assumption. This total credit limit is going to grow because that's guaranteed to happen. That's something that isn't an assumption. You can expect that. So over the next 10 years, let's say this is what happens to her home. It appreciates, the balance accrues more money. That came out weird, but the balance increases because she doesn't make a payment. You'll also notice that her available credit also increased, and that's because the calculation that they use to determine how much bigger this bucket grows, remember we talked about the credit limit increasing, is the exact same calculation that they use to determine the charges on the balance. So if this total grows by 7% and the balance grows by 7%, then this void here, or this difference, the available credit, will also grow by 7%. So 10 years later, she has a higher balance, but she also has available credit, more available credit. And whatever she was doing with that money, rather than paying charges, is somewhere else. Maybe she's invested it. Maybe she's using it to eat or pay for prescriptions or whatever. But we have to take that. You have to look at the whole picture to make sense that this is an okay strategy because that money is going somewhere for her. Now, let's say that she has some neighbors that live in the same value home and they got a reverse mortgage at the same time and it's in the same position. But instead of wanting to stay, they decide they want to move. And we kind of talked about this already, but I like to bring this up because it is a stubborn myth. People think that with a reverse mortgage, the bank owns your home. That isn't true at all. What happens is they have a lien on the property for the balance, which is true, by the way, of every other mortgage out there. So yeah, if you sell the house, are you going to have to pay that balance? And the answer is, of course you will. It's a mortgage on the house. But the rest of it is something we all know and love, and we call that equity. So if they sell this, like you can't sell a house with a mortgage on it and not pay the mortgage. That's impossible. The title companies ensure that. So when they sell the house, the balance gets paid, but the rest of it is their equity. It belongs to them entirely, or their heirs. So let's say that they're selling the house for some parents who have passed away. The equity belongs to the family. It belongs to whoever's on title. Whoever inherits the home, that's their home. But the balance is due, just like any other mortgage. It's a mortgage on the property. It's one that you didn't have to make payments on. But when you sell the house, do you have to pay the balance? The answer is, of course you do. So let's go back to her. Now I'm going to show an example, another time lapse, but let's say in this time lapse, the home value decreases, right? Maybe she's in Phoenix and it's 2007 and real estate values crash. And because you don't know if that will happen to you where you live, this can be really helpful because this is what happens over the next, let's call this another 8 years of time lapse. Let's say over the next 8 years, the home value decreases, but the credit limit itself is still increasing because it's not based on home values. It's based on that 1-year treasury plus the spread. And now she's in this position. The question is, does she still have access to all of this available credit, even though her home value has dropped below that limit? And the answer is absolutely. That's been guaranteed and insured. So she could literally run up the balance and take out all of that value, all of that equity, and then some, and put it in her pocket, put it in investments, do whatever she wants to with it. And when that happens, nobody's knocking on the door saying, hey, it's time for you to start making payments, or it's time for you to move or refinance. None of that can happen by contract because it's not due until she leaves the home. And if she does leave the home in this scenario, this difference is non-recourse. Technically what happens here is she would give the keys to the bank, do a deed in lieu of foreclosure, and say, thank you very much. And the bank would recoup as much of the loan as they could. And then they would make a claim to FHA saying, we need this money back because this is what the insurance is for. That's a claim on that FHA insurance. That's what it's for.
I mean, it gives so much certainty about access to capital and access to those resources where you don't know what's going to happen in the real estate market. And if you're relying on that, you may be having to sell that asset in a time that's not favorable at all.
Yeah, it's almost like I imagine a certain percentage of people watching this video, there's an alarm bell going off in their head that's like the too good to be true alarm bell. Like that doesn't sound sustainable. I'll talk about how that works. Like that insurance pool is funded by the reverse mortgage borrowers. And sometimes you'll come across these people that are just they don't trust the government managing anything. And they might say, well, what if FHA can't pay that difference? What if it doesn't properly manage those funds and they don't pay the bank? And it's like, well, okay, but that isn't your problem. Like that would be bad for the country, but it's not her problem. Like right. The bank can't go after her. They can try to get the money from FHA, and if FHA doesn't have it, that's a problem for the bank, I suppose. But it's not her problem.
Right.
Yeah. So this comes up. This too good to be true scenario gets even more extreme when you think about what if somebody's in this situation and they don't want to stay there. They really want to sell. So they want to move closer to family, or they want to downsize, or they want to move closer to a hospital. All sorts of reasons why they may want to move. If they were in this situation and they use some of the available credit, looks like about half of the total, and the home value decreased, what we would advise them to do every time, and what every financial advisor and every mortgage advisor and every friend of theirs should advise them to do, is don't sell the house. Because if you sell the house, the balance will get paid, of course, like every other mortgage, and you will walk away with your equity. Now that's at least some money. That's not the end of the world, but you have access to additional available credit that is non-recourse. What I would recommend is, instead of selling the house and going through the effort of selling the house and the cost of selling the house, by the way, do a deed in lieu of foreclosure, give your house to the bank and say, thank you very much. And people think that that's like a short sale, but it's not. It's a deed in lieu of foreclosure, and it doesn't even hit your credit because the bank is going to make a claim with FHA and they're going to get the money for that loan as best they can from FHA, and it's not your problem. And in that scenario, you got your equity without the hassle, by the way, of selling, and without the cost of selling, and that additional available credit. And because we're talking real estate, this could be $200,000 that they're additionally putting in their pocket before they move into a nursing home or something like that. That could make all the difference in the world to them. It's huge.
Yeah, absolutely.
Again, this is the part where people, again, that alarm that's saying this is too good to be true, start clinging. And my response to that is, this is not something that FHA is unaware of. It's the risk that they account for when they put money in that insurance pool. It's a type of mortgage insurance. Now, most mortgage insurance that people are used to is something like, if I use an FHA loan to buy a house for the first time and I put 3.5% down and a 96.5% loan, I have to pay for mortgage insurance because in the early years, there's some risk of that house getting upside down. And so there's mortgage insurance because I don't have enough equity for the lender to feel comfortable with that. And that makes sense. But this kind of mortgage insurance, the mortgage insurance with reverse mortgages, is different in that the risk to the insurer is in the end of the process, right? If they live there a long time and the real estate market is soft, or it dips or something like that, the risk is toward the end, which is what they have to insure against. If you were to do this, if your house got into this situation and you needed to make a claim on that insurance policy, it's not unethical to do so. It's like, that would be like me saying it's unethical for me to call my home insurance company if a storm came through and ruined my roof. It would be unethical for them not to help me. I paid premium to cover that risk.
Right. That's what the insurance is for, right? You're just
Exactly right.
you're experiencing the benefits of it more directly than in when people usually think of mortgage insurance, the benefit is really that you can actually afford that loan.
Now, the truth is, this sounds like, oh, this would be awesome because you can take advantage of that process. Now, if your home value decreases, this does save your butt. But like most insurance policies that we buy, we don't really want to use it, right? We buy it for peace of mind. What would be ideal, and what happens most of the time is when people sell their houses, there's equity in it. I mean, I don't want my home value to decrease for any reasons, even if it lets me make an insurance claim on my reverse mortgage. It's not like I want that. What I want is for my home to keep appreciating and for me to have equity that I can use later. It's an insurance policy. It's something that's there in case I'm the one whose home value and frankly, if that sort of thing were to happen all the time, then this product wouldn't really be available. That insurance policy wouldn't really work if it happened all the time. It doesn't happen very much. But when it does, you're protected.